Thank you all for coming. My name is Karen Miller. I'm a member of the steering committee of the Society's Young Professionals Network, also known as the YPN, and I will be your host for this evening. Before we begin, I would like to give a land acknowledgement. The Society of United Professionals acknowledges that the land we are meeting on is on the traditional territory of many nations, including the Mississaugas of the Credit, the Anishinaabe, the Chippewa, the Haudenosaunee, the Wendat peoples, and is now home to many diverse First Nations, Inuit, and Métis people. We acknowledge that Toronto is covered by Treaty 13 with Mississaugas of the Credit. And with that, I would like to give a big warm welcome to our special guest speakers, Ashley Leithwood and Vidal Castillo, mortgage specialists from Meridian Credit Union. Thank you so much for coming, Ashley and Vidal. We really appreciate you taking the time out of your day to come educate us about getting a mortgage and all of the steps that are involved. With 8 years of tenure at Meridian, Ashley Leithwood is a mortgage specialist with a well-established background in the finance sector. Ashley has worked in various roles, including financial advising, and grew as a licensed investment specialist before fully immersing herself in the mortgage industry. This experience has equipped Ashley with the skills to guide individuals through the entire home buying process. From budgeting and investing to credit management, Ashley ensures clients are well prepared for their journey into home ownership. Vidal Castillo has been with Meridian for over 19 years. During this time, Vidal has been assisting Meridian members in different financial service roles and in different Meridian departments. For the last 3 years, Vidal has been counseling members with a range of lending products, including mortgage loans, HELOCs, or lines of credit, major home renovations, and construction loans.
Something around in China, it comes down to mom. Readers read, and knowing and being around not.
Sorry, Daniel, thank you? With over 19 years of experience in the financial sector and with his new role as mobile mortgage specialist, Vidal can provide invaluable advice and guidance regarding your lending needs. Now, before we get started, I'd just like to advise everyone that this session will be recorded, and I will ask all participants to leave questions until the end of the presentation and in the interest of time. So without further ado, I will turn it over to our guest speakers, Ashley and Vidal. Hi, sorry, Daniel. We can't hear anything online, unfortunately. Oh, I heard something.
Can you hear us?
Yep, I can hear you now.
Okay, let's go again. Leave it on that side.
Amazing.
So
Technical difficulties. Yeah.
no, thanks, Dad.
Thank you. Please
Once
proceed.
again, thank you for inviting us. Thank you for sharing your great food. And we are going to hopefully got you through the basic steps of applying, going through the process, and eventually getting your first home.
Yeah, we're really excited to share this presentation with you. So thank you so much, Karen, for introducing us. We hope that our love for mortgages can show through this presentation, and hopefully you will love what we talk about the home buying experience. And if buying is interesting to you guys right now, we hope that this will just help with your passions to make the next step. So the next one.
So this next slide is just a disclaimer as it relates to the material that's being provided here today. And if anything else, then please feel free to review this as it relates to the fact that people might need to review their own individual circumstances before acting on any advice there.
Great. Okay, so has anyone here heard about Meridian, is familiar with Meridian? I know we do have someone already that I spoke with, but anyone familiar with what a credit union is? Yeah, okay, a couple. So Meridian is a credit union. We are the largest credit union in Ontario and second largest in Canada. Our roots dive deep back into history. We were a merger from HEPCO and Niagara Credit Union, merged in, I believe, 2005 to create Meridian. So the main difference that you'll see between Meridian and the big banks is that we are provincially regulated, where the banks are federally regulated. So there are a little bit of differences between us and the banks, but we offer all the same products. So you can come to us for daily banking, for payroll, for investments, for mortgages, for loans. Everything is kind of the same in terms of the products that we offer. But there is a little bit of differences between some of our rules and some of our programs. We're able to help a little bit more, even in terms of financing your property. We have a lot of different programs that are out there that might be able to help you guys in your specific situations. Okay, next slide. So we will take you through today the 5 big steps when you're looking at buying a property. And just keep in mind that every situation is different. Every financial situation is different. So this is just a generic kind of overview of what you would go through to purchase a property. Like I said, there are different programs and different qualifying rules that we can go through with people on a one-on-one basis, depending on your financial situation, because every financial situation and every property that people look to purchase is always going to be a little bit different. So it does vary on a case-by-case basis. But Vidal is going to take you through, is home ownership right for you? It may not be right for everyone. So that's kind of the first step of figuring out if it's for you or not. And then we'll go through if you're financially ready to own a home, things like saving for your down payment, getting those steps ready. Vidal will take you through financing your home. So that's really, what we look at for pre-approvals and actually qualifying you for the mortgage. And then we'll talk about different homes and finding the right home for you, depending on your situation. And then finally, Vidal will take you through making an offer and closing on your purchase.
So 5 steps, based on our experience. Actually, now it can be different lenders, but based on the experience, we felt that these 5 steps will cover the whole process of contemplating getting into the market to finally picking the keys, picking out the keys at the lawyer's office. Who here has already a home? Who has gone through the process? Okay, so the presentation is tailored here for first-time home buyers. As Ashley was saying, every situation is different. But in this case, we are on the assumption that for those who haven't gone through the process, basic questions. So someone calls me and said, hey, I'm considering getting a house. What is it that I need? So basic questions here. Why do you want a home? I mean, do you live with your parents? Are you renting a house? Do you understand the pros and cons of getting into home ownership? What is your current situation? Are you employed right now? Do you have the down payment? Do you have the stability? Do you have the financial? You're prepared to actually own a house. Those who own a house already, and I was talking to briefly with my colleague, my friend over there. Yeah. He's looking to do some renovations. Well, that's part of owning a house, right? That's part of educating first-time home buyers, kids who, they want to have a house, they want to get into the market, but they don't understand yet the process to go through the process here. Are you financially prepared to do this? Is this in line with your lifestyle? Well, some people, they would like to, young kids in particular, like to go for a higher education diploma, like to travel in the world. Well, guess what? Once you get into having a loan, it triggers a different kind of expenses and responsibilities. So it's a matter of understanding part of educating, particularly first-time home buyers, so what it is, what it takes, and are they financially ready for that? So, what is the true cost of home ownership? So again, someone comes with the idea of buying a condo. First thing, do you have a down payment? Right. Depending on whether you want to buy a condo, you want to buy a house, the down payment can be different. Whether you want to, with the minimum down payment, pay the insurance, or you want to go standard and get the 20%, that triggers different scenarios, that triggers different questions that the people need to get educated on that. Upfront costs, of course, it includes the down payment and closing costs, usually 1.5 of the purchasing price. In the past, now it's probably less than that, because to be honest, a condo right now is $600,000. A house in Toronto, I was talking with someone here, you don't find a house when there are $1 million in Toronto anymore, at least in the GTA. Ongoing costs. That's part of the conversation as well, right? Is what is that entails? You buy a condo, you have to be aware that now it's no longer paying the rent only. You're going to pay the mortgage, you're going to pay the property taxes. If you buy a condo, it's condo fee, it's heating cost, and on and on. So part of the conversation, part of the education is, am I ready with my upfront costs, with my costs associated, and continue with this service in the property? And again, if it is a house, like my friend here, repairs. If it is a detached house, be mindful that the roof will need to be replaced. The raccoon entered through the thing, it destroyed the shingles, and it needs to be replaced. The basement, you name it. So that's part of the conversation here. Are you ready to own a house? And if it is a house, are you looking for a condo? Are you aware of what it takes to do this? Financially, you're ready for that. Part of the conversation when we take a credit application.
Okay, so step number 2 is, are you financially ready to own a home? So Vidal touched on some of these points already, but do you have an income? Is your income stable? Because this is a long-term commitment, and you're going to have to continue paying for your mortgage payment, paying for repairs and your ongoing expenses on the property as they come. Do you have down payment? Are you financially responsible enough to save more than, your rent payment, for example? And that's things that we look at when we're qualifying you as well. We want to make sure that, you have enough to pay for your expenses plus more. And then, are you aware of all the costs and the time it takes to take care of properties? Of course, condos, which we'll go through later. Condos and detached properties are definitely different in terms of home maintenance. So figuring out what's your financial situation, and your situation will change that. Next slide. Okay, so Vidal touched on down payment and closing costs. These are the big things that everyone thinks when they're going to purchase a property. It's, you know, from all of my friends, from people that I work with all the time, it's, you know, I'm saving for my down payment. But there definitely needs to be more savings than just your down payment. There's other costs that come up. As Vidal mentioned, closing costs are about 1.5% of the purchase price that you're looking for. You have to have that up front. When you purchase the property, when you're closing on that property, your lawyer is waiting for those funds. There can be home inspection or appraisal fees. This is depending on where you're purchasing, what your down payment looks like. So it may not be applicable to everyone, but those range within a few $100s. Insurance costs. So before you close on a property, you do have to have home insurance on your property. Not too expensive, but it is another cost that's associated with buying. And then potential repairs or renovations. So let's say you purchase a property and during the home inspection, you know that, you know, it's going to need a new roof in a couple of years, or, you know, the home inspection will point out some of the targeted areas that might need some work. And so you're going to want to make sure that you have some sort of an emergency fund to be able to accommodate for that. And then also moving costs, right? You know, once you've closed on the property, how are you going to get in? Trucks, people, you know, that you'd have to pay to get your bed and your couch in there. So just all things to think of. It is definitely more than the down payment. In the last thing that
evolving cost, if you take like a line of credit, then what are the pros and cons of doing that?
If you take a line of credit for the down payment or
for the revolving emergency cost.
You could, but then it's another expense to you. So it's whether that's affordable to you. Again, it's based on everyone's different financial situation.
So does it affect my how much mortgage I can take, the line of credit?
It could, like, it just depends. So if it's just like you want to use it in the future for emergencies, then maybe not. But if you are going to use it for closing costs or down payment, then yes, it would have to be factored in. So it could impact.
Sorry, it's a very good question here. Because when you purchase a property and you put at least 20% down payment, it opens the deal to different opportunities, such as a line of credit. And always personally, and I'm sure that Ashley does as well, we always encourage to attach a line of credit if you can afford it, right? If it is not going to impact how much mortgage you can qualify for. But very good question, very good point. If the member qualifies and there is equity in property, it's a good thing to have. Absolutely, yeah. Renovations, because you always have to work in the house, particularly when it is a detached home. Not necessarily the condo, which is it can apply as well. But you're right, it's something to have, something that can be usable from day one. Sorry
to interrupt, Vidal. I just wanted to, could our speakers please repeat the question before answering? It's just, we can kind of hear the question. Yeah, for our online people. Thank you.
Okay.
Please continue.
Yeah.
Thank you.
Sorry, Vidal. Just follow up to what you just said. Why would it apply more for a detached home rather than a condo?
Don't get me wrong. To both, if you feel that you want a line of credit, both can apply, provided that you put at least 20% down payment, and we structure in a way that we split it, right? So you have some line of credit, and then you have the mortgage, or both, yeah. What I was saying about the condo house is typically the condos require less maintenance and repairs, because condos
A lot of it is included in that monthly condo fee
Yeah.
for you. So they take care of a lot of the maintenance. They take care of the windows outside, or if anything is going on with your unit. For example, I have a unit in Oakville that had some plumbing issues. Well, that was covered by the condo corporation, so I didn't have to pay out of pocket. But for example, I also own a townhouse and the heater went. And that's, you know, there's no condo fee for me there, so I do have to pay for that upfront. So detached normally does have a little bit more in terms of repairs and maintenance. And of course, like shingles or stuff like that, roof repair, anything like that, you would have to cover with your own funds versus a condo. Is most of it's included in the condo fee, but not all.
Thanks. And sorry.
Yeah, thank you. Good question. So how to save for a down payment? What types of down payment are possible? Does everyone have a TFSA, tax-free savings account?
Yeah.
Yeah,
With Meridian, right?
It's gone down recently.
yeah, yeah. What about RSP account, registered retirement savings account? Yeah. And what about the newer one, the first home savings account? No, not yet. Some of you, some. Okay, so TFSA, you guys already probably know, you know, you use your after-tax dollars. So whatever you get paid from your employer, for example, you put it into your tax-free savings account. Whatever gains that you get in that account, you can withdraw tax-free. And it's a great tool to use for your down payment. The RSP is also a great tool if you're using it a part of the home buyer plan. So for first-time home buyers, if you do have an RSP account, you can withdraw up to 60,000 out of the account, and you can withdraw it tax-free. But then you do have to pay it back over a 15-year period. So you can kind of thinking of it like you're borrowing it from yourself because you're repaying it back into your retirement account to be used for later.
What is the interest on this payment?
So TFS, all of these three accounts, the first home savings account, RSP, and tax-free savings account, you can kind of think of them as like umbrellas, and then you can have different products inside of them. So you can invest in mutual funds in them, you can invest in stocks and bonds, or you could just have it in a savings account, all within that account. So
For
it
example,
does.
I borrow from my own RSP. If I have to give it back, then what is the interest rate charged for that? Or is it interest free?
There's no, yeah, it's interest free. So you just take the amount that you take out of your RSP. So for example, if you took the full 60,000, when tax time comes, they would calculate it by 60,000 divided by 15, and that's how much you have to pay every year. If you don't pay it back into your RSP, what happens is it gets added to your income at the end of the year, and it could push you into a higher tax bracket, and then you'd pay tax on it. But yeah, I hope that answered your question. Yeah, okay. And then the first home savings account is kind of like a mixture between the tax-free savings account and the RSP, where you can invest in it. You do get a tax deduction when you invest in it, and then your funds can grow in it, and you can withdraw them tax-free for the purpose of buying your property. So it's really best to consult your financial advisor on which ones you guys should be investing in, which ones you should be using up first, before you go on to other ones, because every financial situation is different. So yeah, definitely suggest going through. And then again, all of these products can be within these accounts as well, or you could have them just in a non-registered regular savings account. So when you do come to qualify for your mortgage, what we look at in terms of down payment would be a 90-day history of whatever your own savings are. So we want to make sure that those are your own savings, and we're not seeing big transfers in from gifted money or anything like that, or else it would go through a different process of gifted funds. So we do look at a 90-day history of your funds to make sure that they are your own savings account. Gifted funds are also very popular in today's day and age.
Hi, Ashley. Sorry, we have a question online actually.
Yeah.
Daniel, would you like to unmute yourself?
Yeah, quick question. Is the 90-day history, is that a policy specifically for Meridian or is that like a federal law?
So that is Meridian's policy. I do know some lenders like Scotiabank, for example, only requires 60-day history. But most lenders that I know of do ask for the 90-day history. I'm not sure why Scotia is different, but yeah, you can inquire with your lender.
Scotia needs 98 from from last year,
Oh, it changed now.
especially for immigrants who are not from Canada. They do ask for 90 days.
Gotcha. Okay. Yeah.
And do remember that the reason that we ask for the 90-day history is another reason is because we want to make sure that those funds are not being borrowed. And because if you borrow the funds, I don't know, you transfer it from your credit card, you name it, then that is going to impact how much you can afford. Because now, let's say that you borrow $20,000 for a down payment, now you're responsible for this obligation as well. And that is going to diminish how much mortgage we can give you. But as Alcho was saying, totally, I think that is most A lenders will require at least 90 days of funds on deposit.
Yeah.
Savings accounts. And that, and again, I was very important to keep track of that. If you're looking to put an offer, please do that because there is always, sometimes it's hard because most people have savings accounts here and there in different financial institutions, and then decide to consolidate everything in one for the deposit, and it becomes a nightmare. So if you can take a lot of things on this presentation, one of them is I need to keep track of my paper trail because I need my 90-day history. Yeah, but that's basically the reason. Sorry.
Okay, yeah, and then government housing grants. So a lot of this varies and the programs come and go, depending on when it fills up. So if you are looking for specifically government housing grants to help with your down payment as a first-time home buyer, you can check with your local municipality to see what types of programs are going on. Every municipality will have different rules and qualifying rules on whether you qualify for it or not. But there's also additional programs out there. So I don't know if anyone's familiar with the company's Options for Home or Habitat for Humanity. They are two of the pretty popular, especially in the GTA area. And they essentially provide you with a loan to help you with your down payment so that your mortgage amount is lower, so your monthly costs are lower. There's no monthly payments associated with that loan, but they do take a piece of your equity. So they do share in the equity of the property. When you go to sell that property, if your property has appreciated, then you would owe them a portion of that appreciation because they gave you the loan. So there are quite a few providers that do that, and they all have individual qualifying rules depending on your income or your family situation. Some are targeted to people with children, some are not. They're all very different. I would suggest reaching out to a mortgage advisor or a real estate agent just to figure out what's going on in your area. Because like I mentioned, like there's so many different programs out there, but they're all in different areas.
Right. So I'm not sure we talked about the gifted fund or I missed it. So that gifted fund, it's acceptable from the Meridian side, and there's any limit or?
Yeah, so gifted funds are acceptable. What we require is a signed gift letter. So Meridian and any financial institution will have their own letter template that you guys would fill out, and it would just state how much is being gifted. And then we also need what's called a donor statement to support that they have the funds to be able to gift you.
But it's from outside of the Canada, all we can.
Yeah, so then we need a trace or a track history of the wire transfer of it coming in.
But I know even from a back home side, you can't have any wire to any bank in Canada because of the sanction. I can get the money, just the pile of money. I can't get it through the wire.
Not necessarily. So we run into this quite frequently, particularly here in Toronto, because we are city that is actually a lot of oil and gas here at least. So we run in, at least we run into this a lot. So there is a couple of professionals who work in Toronto or Canada. Their parents are in China or in India or whatever. So those funds are acceptable, provided that they provide the letter that Ashley was mentioning, provided that they show a bank statement that shows the funds and their donors, whomever is gifted, their name is their funds, the request to wire the funds, and the transfer form plus a statement here showing that the funds arrive to the member. In terms of the amount, it really doesn't matter. If you buy a property for $100,000 and if a family wants to give you 50%, absolutely right. Yeah.
They're losing a lot of tax on that money when it comes in. So that's not you. They can send a lot of money, but then they need to,
If it's a gift, then.
yeah, you still need to pay, I think, about some
No.
money. That's what I was.
Sorry, what was the?
Is there a tax limit? Like, say, they want to gift, like, say, 100,000. I'm not sure, like, the country, Canada taxes, but the country they're sending from in India, they tax it.
I had maybe in the last 2 years, maybe 5 or 6 buyers who transfer funds from India. And as far as I know, there is no taxes associated. And I get the statements and I get all the white forms. I might be wrong. I don't know how the tax system is in India, but to answer your question here is, it really doesn't matter the amount. We're not sure about the tax system there.
As far as I know, if it's above 7 lakhs, you
Yeah,
do pay the
tax.
tax because at least for my
20%.
tuition fee, my mom and dad
Okay.
had to transfer the amount, but it was like a wire transfer directly to my institution when I started master's here.
Okay.
So, yeah, if it is a one-time payment, which is above 7 lakh Indian rupees, you do have to pay an additional tax. If it's below 7 lakhs, I think
Okay.
there's no
There's
tax.
no
Yeah.
So that's probably going to change based on the country, right? The
Right.
amount of taxes. But for the purpose of the down payment, it really doesn't matter the amount, provided that there is a paper trail confirming that the funds indeed are from the family member and they are arriving at the person buying the house. The other part, when it comes to gift letters, it's got to be from an immediate family, meaning sister, parents, family, siblings, not necessarily a cousin or a friend, because that's not accepted. Great question.
And another popular one is inheritance, unfortunately. But inheritance can be used for your down payment. Okay, so now that we went through kind of what can be used for down payment, a lot of questions that we get is, okay, how much do I need for my down payment? And that really depends on where you're purchasing, what you're looking to purchase, how much you have. But potentially you could purchase for as little as 5% down through the high ratio insurance program. So I'm not sure if anyone is familiar with the program, but there are some qualification rules associated with it. So you do have to purchase it as your owner occupied property. You can now, as a first-time home buyer, you are allowed to go up to a 30-year amortization if it does help with qualifying. But there is a tiered down payment requirement, and that's 5% on the first 500,000 and 10% on anything above 500,000. So just as a quick example, if you want to purchase something for 600,000 with the minimum down payment, it would be 5% on that first 500,000, so 25,000, and 10% on the additional 100,000. So in total, it would be 35,000 that you'd have to have for your down payment. Now, along with this program, there is an insurance premium, and I'll go through it in a couple of slides. But it really depends on what amount you are putting down as your down payment. Because you can put, for example, 5, 10, 15%, anything under 20% down payment would be under this program and would include this insurance premium. So it does vary just depending on the loan to value. And the loan to value is just simply the loan amount compared to your purchase price. So if you're putting 5% down payment, that means your loan is going to be 95% of the purchase price. So then you'd fall under the most expensive category of 4% on the mortgage. And I'll go through an example later in a couple slides
I've
of
heard that if
what
you
that
give
looks like.
like very low down payment, your interest rate actually is lower.
It
Is
is,
that true?
yeah. Yeah, so you do get a lower interest rate if you are qualifying in this high ratio program, which I'll also go through in the example. It'll show the reduced interest rate. Thank you. And then the only way to avoid this insurance premium is by putting at least 20% or more as your down payment. Once you get to 20% down payment or more, you're a lot more likely to be able to access your equity out of the property earlier if you do want to end up getting a home equity line of credit on the property. And it also opens you up to qualifying, like having more, what would you call it? Like flexibility with your qualifying. So Meridian as a credit union, you don't necessarily have to qualify for the stress test with Meridian. So if you guys are familiar with the topic of stress test, it's that you have to qualify for a mortgage payment that's 2% higher in rate than whatever rate you're actually getting on the mortgage. And it can definitely impact how much you can qualify for. So we do have some programs that allow for a little bit more flexibility, but you have to get to that 20% down or more. And then this is just the best example is just, for example, a condo in the area here. I just took a snapshot from realtor.ca over the weekend just to show you what it would look like when you're purchasing with 20% down or with just the minimum down payment. And it's going to include that insurance premium, and it's also going to have the reduced rate because it is an insured loan. Lenders do get lower rates for it. So just as an example, you purchase this property for $575. Your down payment, if you're putting 20% down, is pretty significantly higher than if you are doing the minimum. But then we do include the high ratio premium. So because this is the minimum, this is going to be the highest premium at 4% of the mortgage total. So your mortgage loan is going to be over $100,000 more because obviously you have a much lower down payment. And then you get the reduced interest rate because it is insured. This is an example of just using 25-year amortization, but you do have the option for high ratio to go to 30 years if you are a first-time home buyer now, and you do have flexibility with just a regular conventional to go to 30-year amortization as well. But so the monthly payment, of course, your mortgage loan is quite a bit higher. Even with the reduced rate, it's still going to be more expensive in this example for this property if you put the minimum down payment. But it does let you get into the market sooner. You could potentially be gaining equity in your property. And then here's just an overview of like your total costs on this property because it is a condo. So it does have maintenance fees and then property taxes. So it'll just show your total cost. And in these days, it is more expensive in some cases to purchase a property than it is to rent just because of how high mortgage rates are, although we are starting to see them fall. But so the high ratio one would be just over 3,600
So
and
this
conventional.
3.89%.
Pardon?
This 3.89% mortgage. Let's say I'm paying 5, but let's say I'm paying like 15 or 18% of the down. So will I still have the 3.89 or will it go up?
No, you would still have the 3.89 because you're purchasing with less than 20% down payment. But then it's gonna reduce your mortgage amount, and it's also gonna reduce the premium because
So that
you're
is
no
better.
longer gonna be in that 95%.
So that will be better, no? Because I'll have low interest rate and I'll also have low,
Yeah, there's definitely a million different scenarios in between these two. This is just kind of showing one extreme to the next, full 20% or minimum. But yeah, if you were to put 15% down or 17% down, it likely would have a lower total payment because you are putting more down and then you're also saving on that premium. So again, everyone's financial situation is different. So if you work with a mortgage specialist or a mortgage broker, we can kind of map out a couple different options depending on what you do have for down payment right now. And we can look at a few different scenarios, and we can also look at potentially waiting until you have that 20% down. And we can go through that with you. But that's just kind of a snapshot to show you the difference between the two.
But that is a very good point that you make, right? Because maybe 6, 7 months ago, the rate for an insured mortgage was lower versus the conventional one. So if you put, let's say, 19% down payment, you still get the lower rate. So the question that was sometimes I sit down with the member to say, okay,
Yeah.
so Mr. Member, so what if you pay the insured, which is insurance, put 90% down payment, you get a lower rate, the premium is significantly lower than the minimum, and you actually come ahead of the game. So it's a very good observation, and it came into play maybe with the summer of last year, because now a conventional is say a 6.4% at one point versus what 4.99 or 509 at an insured one. So of course we're looking at almost 1.5%. Running the numbers and said, okay, you know what? It makes sense for you to add $3,000 in the mortgage because in the life of 5 years, you're going to get ahead. But yes, absolutely. It's just a matter of how the rates move. And this is where you need to sit down and say, okay, so what is that I'm seeing right now and how can I run the numbers to assist the members here to provide the best solution at the lowest price? Very good point. Yeah. Now you're ready to finance the home, right? So you went through step 1 and 2, and now you're looking for how am I going to finance the property? So when you come to Meridian to mortgage specialist or a broker, and they say, you know what, I'm looking to buy a house. I'm looking to put an offer. I'm looking to get into the market. So the first step, get a approval. Get a approval letter, right? Before you actually start talking to a real agent, talk to your broker, talk to Meridian, talk to Ashley, talk to myself, because you will need a approval letter for 2 reasons. One, you want to make sure that when you engage and sign the contract with the real estate, he or she's going to take you seriously, right? Because now I showed that I got a financial institution who's giving me this amount of mortgage. Now the real estate agent know what's more or less the target price, right? 1, 2, you want to preserve the rate. Most financial institutions will save the rate for 90 to 120 days. Letter said, we're approving you for this. We are giving you this rate for 120 days. If for any reason you put an offer during these 120 days and the rate that we promised on the letter is higher than what is posted right now, Meridian always honors the lowest. It will give it the lowest or will honor whatever it is in the letter. So that's the approval. Again, it guarantees for 120 days. Your real estate would actually have an incentive to say, okay, so let's go for it. Let's put an offer. Let's get the house, right? During the interview, typically what we're going to do here, we're going to review again. So are you ready to go into this? Do you have the income for that? Do you realize what it takes to sustain this property? I'm going to ask you for your 90-day history of your statements, or at least a statement that shows I have these amounts of dollars and I am going to use it for my down payment. Your liabilities, right? So part of the application, I'm going to put an Equifax or a TransUnion, whomever you deal with. I'm going to look how it looks like. Do you have a good credit history? Do you have student loans? Do you carry balances in your credit cards month after month? Do you own a car? Do you lease a car? All these things will impact how much mortgage you can afford. So if you're looking to buy a house in the very near future, maybe this year, and you're looking to buy a car, lease a car, just hold it for a little bit. If you're seriously looking to get a condo or a house, right? Because that is going to impact how much you can afford. Okay, let's do 70% of the interview for a credit application to buy a house is going to be on your income. Right? Forget about the credit. Of course, you get a bankruptcy, that's not going to fly. But 70% of the time when I take an application, I need to understand how do you get paid? What is your structure? Are you on salary? Are you a business for sale? Are you hourly? Are you part-time? Depending on what is your income structure, I'm going to ask you for a kind of different documents. If your salary, I'm going to ask you for a pay stub. I'm going to ask you for your T4. If you get a bonus, I'm going to ask you 2 T4s the last 2 years. If you have a business, and this is what is going to cover my mortgage payment, I'm going to ask you for financial statements. I'm going to ask you for your T1 generals. I'm going to ask you for business bank accounts. Yeah, so sometimes we're looking at the numbers and said, okay, so this is the maximum we can go at this rate for this purchase. But what if I buy a house that has in-laws entrance, separate entrance, basement? Can I use the income for that? Absolutely, I can use it, provided that this is a duplex legally in the MLS listing, and that is listed as a duplex. Then I can use the income. If it is not, even if you actually declare this income in your T1 channels for taxes, we may not be able to use it. I know for a fact that other financial institutions may do it. Meridian doesn't do it. We want to make sure that it is a legal duplex and that it is registered as a duplex. Another source of income, and people don't think about it, is child tax benefit. Depending on how many kids people have, couples, it can be a very substantial source of income or qualifications, provided that the children are 12 and under. And that's basically how people earn their monies.
So is there something like an average of how many years you have to earn to like qualify for the house?
Years working.
Like, for example, this year my income might be, let's say, 120 or 130, but last year it was, let's say, 70 or 80. Then does the bank do an average of both, or is it still my?
Why is the difference here?
Let's say switch jobs, maybe.
You switch jobs.
Yeah.
Okay, so you were working in 2024
For a lower salary, but now I work for a higher salary.
and now you move into a different employer in 2024, and now you earn higher.
Yeah.
We will use the higher, provided that A, you're not on probation, right? This is a letter of employment that says you're not on probation, and there is a letter of employment that's showing your new salary, pay stuff, and everything matches. Yeah, so we can use that. Yeah. How much you can afford and how we arrive to this amount of mortgage. Basically, 2 rules, right? In terms of shelter costs, because that's what we're talking about here. How much house can I afford with my salary? As a rule, and we follow the government guidelines, out of each dollar that your household brings to the house, meaning salary, bonuses, commission, child tax benefit, you name it, 39 cents, it cannot exceed 39 cents out of each dollar to cover your shelter costs, meaning mortgage, condo fee, property taxes, and heating. That's the bottom line. That's your qualification here. The second one here is it. Mortgage payments, property taxes, condo maintenance fee. Rule number 2, go ahead.
If you work and your company has a defined benefit pension plan where they deduct 9% of your pre-tax gross income, are you basing it off of that total income pre-tax pre-pension contributions? Or are you basing it off of your total income pre-tax post-pension contributions?
We take gross income, meaning before deductions. So if you are making $150,000 a year, that's what we're going to use. Yeah, perfect. Rule number 2 here. So the first rule is shelter cost. The second rule is the total liabilities that you have out there. The rule says basically my application cannot exceed 44%, meaning out of each dollar that we bring to the household, no more than 44 cents can be used to cover rule number 1, shelter, plus any other cost that you may have out of this, meaning student loans, car loans.
So how this will calculate? For example, the credit card, right? For example, car loan, okay, I have it's a $500 car loan per month. You deduct that, but what about credit card? Like credit card is like variable, right? Sometimes I'm using, let's say, $3,000, sometimes zero.
Remember, when we pull the quick access, it's just one shot, right? At this moment is what you owe on the credit cards. That's what I'm going to use, right? So if for any reason this number goes over the 44%, and if I exclude this payment on the credit card, now I bring my numbers online. When I say, yeah, maybe we can keep it this long, but you need to show that this credit card is paid. And it happens a lot. I mean, we have different programs such as cashback that we can advance so we can help you if there is a need for that. But yes, so it may or may not impact your application. Some situations you can, so sometimes with conditions. Okay, the only way that we can proceed, you pay this student loan, you pay the car loan, or you clear the balances in the credit card and you show that it's being cleared. So this is the way that Meridian adjudicates an application and qualifies you for the amount of mortgage for this.
So these 2% is just for the Meridian,
Which
or
one?
is for the old lender?
This 3944? I'm going to say that A lenders, meaning the 5 banks and major credit unions, will abide by this rule. Now, there is some other lenders, and we're going to talk about this. There's so many lenders out there. They may go higher. B lenders, particularly private lenders, they don't care. But your question, yes, we will do this because that's
Private have higher interest rate, right?
sorry.
Private lenders have a higher interest rate, right?
D lender.
Lenders?
Yeah.
B lenders and private lenders have a higher interest rate generally, and also additional fees associated with going with them.
Yeah. Okay.
So step 4 is finding the right house. So, as you're going through with Fidel and you're figuring out how much you could qualify for, it might already kind of determine where you go in terms of what you can purchase. But the 2 main categories are really anything that's a condo. So a condominium or a condo townhouse, anything that has a monthly maintenance fee on it would be under the condo category. A lot of the time, like we were talking, different expenses in terms of renovations or repairs. A lot of the time, the condo corporation will do a lot of the repairs, just depending on what it is. I mean, if you break your kitchen cabinet or something like that, that's obviously on you to repair in a condo. But for the main part, anything kind of outside, any of the maintenance outside is taken care of by the condo corporation. So there is a monthly fee associated with that. And a lot of people kind of will go more towards a freehold because they don't want to pay for the condo fee. A freehold would be, you know, a townhouse that doesn't have any monthly condo fees, a semi-detached or a detached property. So we do tend to see a lot of people, especially if they're in the GTA, they start to look a little bit elsewhere, outside of the city to be able to afford a freehold in today's environment. But the freehold would you would just have to pay your property taxes, and then you have all of your utility fees separately that you would pay per month on top of the mortgage. The condo would be, and sometimes is the same, but also the condo fee. Some condo corporations do include utilities in that condo fee, others don't. So it just depends on the condo that you're looking to buy. But really, the biggest thing that I would suggest when you're debating between condo or something that's freehold is your lifestyle and where you want to be, because purchasing a property is a long time commitment. You can sell to purchase something else, but depending on what's going on in the market and whether it's appreciating or depreciating, it could have an impact on you moving. Just as an example, you know, when I went to purchase my first property, I really wanted a backyard, and I was for sure set on a freehold property. And then I bought one, and I didn't realize how much maintenance was required, mowing the lawn, shoveling the driveway. And I'm a busy person. I'm out in the evenings, I'm networking, I'm always out of the house. So it really didn't align with what I actually needed at that point in my life. So really taking a look at your life and your lifestyle is so important when you're deciding what you want to do. And then both options do come in the form of a pre-construction. So pre-construction is really you're purchasing a property before it's been built or as it's being built. So you're not able to purchase it and move in right away. It's still being built. There can be a lot of pros and cons with pre-construction, especially in today's environment where properties are not appreciating the way that they once were. You know, some people are purchasing these pre-constructions at a discount and hoping that when they close on it, the property has appreciated, and they could sell it for a profit, or they could move into it and have a lot of flexibility with it. But a lot of people are finding that, you know, the property may not even be worth what they purchased it for. And they may have to put a larger down payment on it. So if you are considering any sort of pre-construction or any type of property.
One in pre-construction, I've also heard like they can break their commitment. Like they can say, okay, I thought it will be finished by 2026, but now it is 2029.
So and it depends what brokers what builders that you work with and what the contract you sign is. So what I definitely suggest before signing for any pre-construction is talking to a mortgage advisor about the pros and cons of it. And also before even signing that agreement, have your lawyer look through it to find any loopholes where you might be able to get out of it. Because if it is on time, and you have to close on it and you can't close on it, then you're losing your deposits that you put on that property. And again, there's like, you could potentially assign it, do an assignment sale to try and sell it. You can try and work with the builder, but there's definitely a risk with purchasing any type of property, but specifically for pre-construction, I would suggest just, you know, definitely talking to your mortgage advisor if that's something that you're interested in, just to know, you know, what you need to know. Because even qualifying, you know, you're qualifying today, but it's not closing for 2 years maybe, or 3 years if it's delayed. And then you've got to requalify closer to when you're actually going to be closing and moving in on that property. So there's a lot of little things, and we do have programs for this where it does extend your approval period to a year or 18 months to allow for that bill to finalize, and we'd still have your mortgage locked in. But yeah, I would just suggest definitely have a lawyer look through the contract before you sign anything. And that's even with any sort of builds, if you're looking to build a purchase through like an alternative builder where you're actually the one that's helping with the build. If there's a contract, always have your real estate lawyer look it over.
Ashley,
Yeah.
before we move on, we have a question online. What if you have an investment loan? Will this impact the application?
An investment loan?
An investment property?
No,
I
so
assume, yeah.
yeah, sorry, I'll speak up. So thank you, Karen. So actually, like investment loans, like for example, to invest in the stock market. So let's say you go with a like a B2B loan, um, and then use that money to invest in the stock market, for example, and then every month you're just paying interest off that loan. Would that affect any application?
So yeah, so if you are using a loan to invest or a line of credit or something like that to invest, and it does have a balance on it, then yes, we would use it in your qualification. So if it has a balance on it and it's a line of credit, for example, we would use 3% of the balance. Now, if it is being paid off, like you're taking the investments out, it's being paid off during the process, then we wouldn't take it into account. But yeah, any loans or lines of credit that have a balance would be factored into the application and could impact your qualification.
Now,
Great, thank
just
you.
go ahead. Go ahead.
He said, thank you.
Oh, okay. So I just wanted to add to this. Would you refer it to actually taking a loan out of the bank, line of credit or something like that? Or you mean leveraging investments, like using investments to invest? What was the question?
So it's like taking an investment like loan from the bank and then investing in like a mutual fund that bank manages. Um,
I think that this is going to impact in two different ways. One is your affordability, because we're going to take a 3%. If it is a loan, it has a monthly payment, right? So it's there. So we're not going to change it. If it is a line of credit, it's going to change and we're going to take a 3% of the balance, right? So now we're dealing with a liability that we need to take into account. And if that investment that you invested, you're going to use it for the down payment, we're going to pull it back as well. We said, okay, so you need to show that investment that you have, that you use to borrow funds, is not going to impact the down payment. That makes sense?
okay. Thank you. No, it does make sense. Yeah.
Okay, so your home buying team. So you're mainly going to work with 3 people when you're purchasing a property. That's your real estate agent, your lender, and a real estate lawyer. So initially you might start with, you could start with a real estate agent or your mortgage agent just to figure out how much you're qualifying for. But real estate agent, it's really important that you look at the reviews. There's so many people that are real estate agents out there right now, and you want to work with someone that's really good and really knows the area that you're looking to purchase in, knows the community, knows what's going on. Just as an example, my real estate agent was so great, and she kept thinking of things out of the box for me when I was looking to purchase a condo. She made sure that we went in at a time when the train was going by, because there was a train nearby, and she wanted to make sure that it wasn't going to be too loud. So really having a good real estate agent that knows your area and knows what you're looking for is so beneficial. And then your lender, so whoever you're working with as a lender, and like we were mentioning before, there's A lenders, there's B lenders, which usually have a higher rate, and they also have fees associated. And same as private lending is similar to higher interest rates, more fees associated. I would suggest starting with an A lender to initially qualify to see if that's something that you can qualify with us. But I would definitely say that your lender does matter, who you're working with. What types of mortgage features that they have. Let's say, you want to buy a condo, but you know that eventually, you want a family, you want to end up moving into a house. You want to make sure that there's portability options so that, you can port the mortgage from one property to the other. So you're not going to have to pay prepayment penalties or any fees on the mortgage when you go to break it. And there's a bunch of little features associated with your lender that definitely does matter, and who you're working with, I would say, matters a lot. You just have to really trust the guidance that they're giving you. And for me, whenever I'm working with someone, it's whoever's going to make me think kind of outside the box of options. Even like Vidal was talking about, putting 19% down payment, still having that insurance premium, but having a lower rate, and ended up in that situation a year or so ago where it was beneficial to people to do that. So, working with a specialist instead of just an advisor at one of the branches, I would suggest for your first time home purchase, it's someone that's specialized, they know what they're doing, they have years of experience, and they bring that to the table for you. And then the last one is really your lawyer. So your real estate lawyer, a lot of people don't even know that they need a real estate lawyer, but that's who you're gonna end up giving your down payment and closing costs to. You cut them a check at the end, but they are pretty much the people that are transferring the title ownership of that property over to you. They're also making sure that there's no liens on the property or anything like that. That all gets paid out by the sellers before the transfer happens to you. But they are a really important part. They just come in closer to the end once you've had an accepted offer, or if you're going to purchase something, you can have them read through your purchase agreement as well to make sure that there's no added clauses or anything.
So just gonna add a couple more things. One of real estate agents. Remember, the real estate agent is going to be working for you. They are on commission. They are going to negotiate. They're going to show you the properties that are in line with what you're looking for. They're not going to negotiate for you. Get the real estate agent that you feel that you're going to work for, that you feel okay working with, and that they are actually working for you. Remember, they are on commission. If they don't sell this house, there is no commission. So they have an incentive to potentially put you in situations that you ended up in a nice place. Namely, do I put a financial condition on this? Do I close right away? What if the seller is looking to sell quickly? Is there a leverage that I can lower the price? So interview, ask questions, and get a real estate that you can work with. Okay. That you feel okay, you and your spouse or your family, whatever, right? Now what's on the lender? Ask questions, for God's sake, right? I'm lending for 15, 17 years, and I run into all kind of scenarios. I like when people ask me questions. Okay, so what are the futures with this? What if I do this? What if I do that? And our job, as Ashley was saying, brokers and Ashley and myself, we're 100% on these things all the time. Always lending, always looking out the box. How can we help the members achieve their goals? So ask questions. Don't be shy. This is not a car. This is have $1 million mortgage that you're gonna live for 25 or 30 years. So don't hold on and ask the questions. Lawyers, of course, they just make sure that everything is fine. Fraud in this industry. In order for to be fraud here, and it happens a lot, these the people need to line. And it happens. I can tell you, we cannot tell you how often we run into these kind of situations where they collude, right? So get the right real estate, ask the questions, the lawyer is okay, right? Most lawyers will abide by the license. Anyway. So you found the house, you got the approval, now you found the property, right? So you found the property here in this building, I don't know. Very stressful, right? So you have Janet Smith, who is the real estate, you found the property, and this is my house. I see it myself planting flowers or put them on the balcony, I don't know, right? So what do we do now, right? So you have the proposal already, it is 120 days. You're sitting in the car, talking to your real estate agent, to the other real estate agents. What is happening here? Putting an offer, negotiating, whether I put a financial condition, whether it is the right price. And it is stressful. I can tell you for first-time home buyers how they report to us is so stressful, right? But on the assumption that finally $500,000 MLS listing, you agreed on $590,000, offer approved, accepted. Now what? Well, the first people that you need to get is who is giving me the approval here? I need right away. Well, let me backtrack here. So part of the negotiation here is, and part of the pressure here, particularly in the last 2 or 3 years, is do I go with a financial condition or not? Do I put a inspection condition or not? Again, the real estate agent is looking for commission. He wants to get the property because now that is my salary, right? So there is an incentive, particularly in the last year and a half, to go with a financial condition. What it means here is that the moment it gets accepted, you gotta pay for this. It's not close to get out. If you're closing on May the 15th, you gotta pay for this. Remember, you have a piece of paper that is a approval. It's not a firm approval. We wanna take a look at the property. So the moment that is accepted, and hopefully there is a 3 or 5 business days condition, financing, that's what we need. My MLS listing, I need my agreement of purchase and sale. And part of the negotiation, you need to put a deposit on the agreement. And usually it's the next day. So the real estate is going to ask you, okay, it's accepted, congratulations. Now I need 20, 50 or whatever thousands of dollars to firm the agreement. Paper trail. If you're going to wire it, I need a copy of that wire, transfer to the trust brokerage. If you're going to issue this as a draft, I need a copy of the draft. And I also need the bank statement that shows where this money is coming from, because this is my 90-day history. This is what I need. Once I get this, I'm going to go back and I'm going to get you approved. Finally, it's done. Approved. We're closing on June the 15th. Everything is, we get the appraisal as well, right? Remember, depending on whether you put minimum down payment or you put the 20%, if it is minimum down payment, the insurance typically, most of the time, will take care of the appraisal. If it is 20% or more, we need to price the property. We're not going to do this in 3 days. So that's a condition here, right? That we're going to part for later. But the assumption that it is accepted, closing on June the 15th, everything is sealed. We wait, appraise, and then we're going to ask you for the lawyer's information. Wait for the 15th. You meet with the lawyer, you meet with the branch, you sign documents, you pick up the keys to the lawyer's office, and we're done. And that is the process of buying a property. One more thing here is credit and buying a home is it can take different directions here. So this is very basic. Every credit application, every person is different. So this is a general introduction to what it is.
So I heard that some properties you can find which are like some kind of stress sell and it is done by banks. So how do you find those kind of properties?
Real estate agent can find them.
Which one?
Yeah, a lot of, like, if the banks force people into a sale and then it's usually, yeah, there's some real estate agents that, and I think you work with one that
It
Do you
would be
not?
mentioned inside the listing
For which
itself,
one?
saying it's power of sale.
Oh, I see.
Alternatively, there's
Yeah.
occasions where the courts will actually auction off specific properties too. There's an
Yeah.
upcoming date.
Because like normally, I just search for listing using the house sigma, but I don't see those kind of properties in there. Maybe house sigma is just because it's open source, so
It's not like a free.
yeah.
Power sales homes is happening not a lot, I'm gonna say,
More often.
but it's happening more often in the last maybe late 2024, in the last few months. Sometimes they're listed, sometimes real estate agents and Meridian, as far as I know, and I start working with the real estate, we have a special credit department that will work with the branch, and the branch will find a real estate to do a quick sell, and that's done. But I don't think that you're gonna find them listed in the MLS.
Yeah.
It's more, I will say, get a real estate agent and be specific. I'm looking for an opportunity to get a power to sell property. Doable. You may get good deals
I
there.
heard like they have better deals than the normal property.
Better.
Because they're looking to sell up very quickly, so they might be at a lower price.
You're absolutely right. Because remember, we gave you a mortgage and the assumption that you're going to pay us back, right? But if you default on this loan and we ask you to pay, and then we beg you to pay, and then we call you and you don't respond, then you do what is called the power to sell. It's a power to sell. That's it. And our goal is to pay the loan, pay the fees associated, pay whatever is cost associated, and the rest is going to the member and we can find it. But you're right, it's a quick sell. We need to sell quickly.
I thought the power sale mostly is, the cash type of, it's not something you can get the mortgage and then go buy one of those power sales. I thought those property mostly, it's the people, they have, pile of cash to stay looking for something, if they see something. Because the bank, when it's selling it, they're not gonna wait 3-4 months, get the approval, bring it, kind of thing.
Yeah, they do want a quick
20%.
sale, so
It's a quick
cash is
sale,
the
and
quickest
most of the
sale,
time, they
yeah,
use the cash,
So,
yeah.
so here is the question, right? So here is the situation. I have a house that I need to sell because I need my money back, financial institution. I see someone applying for a mortgage and I see a bunch of cash in there. Which do you think I'm gonna use?
Yeah, that's correct, but mostly what I'm saying, when it's the power sale from the bank, even they don't look at the kind of to see if somebody gonna get the mortgage approval. Every time is it just a cash transaction kind of thing. Okay, this house, it's a power sale. We had, let's say, $1 million mortgage on it. I want to get over 1 million, and whatever you want to pay over, if it's worth over than that, it's gonna go to the who was the
It's
house
possible,
owner kind of thing.
it's
So
possible that we do mortgages as well. Because remember, once a quick sale doesn't mean overnight, right? As long as it is solid applicant and they qualify, everything is fine. I don't see why we shouldn't do this. It can be, like a private sale. I mean,
Yeah, but I do agree. The person that's selling it wants a quick sale, so likely if they see an offer of cash or if they see an offer that someone does not have any financial conditions in there or no conditions and they want to purchase it, even if they have a mortgage, they're likely to take that over a first-time buyer that, we do tell you to put in conditions because that's going to protect you. Anyone that's purchasing and they require a mortgage, we do suggest you put that condition of financing in, and it's only there to protect you. To have the bank be able to verify that we will be still willing to lend you on that property. But it can deter any sort of quick sale or something like that, because from a seller's perspective, if they've got a firm offer right here that they don't have to go back to their bank to confirm it, then yeah, I'd likely take the cash offer if I need to sell quick. But it's every situation is a little bit different.
Even buying a regular home, right? Real estate agents, if I put an offer, if I quotation for 5 business days, John Smith, and John 2 says, no condition. The seller is gonna get this because it's firm now. I'm not sure about this. Maybe they will not qualify versus this one is firm. So I'm gonna take this one, right? Again, that's real estate agent insight on the situation and in negotiation skills as well. That's what I'm saying. Get a good real estate agent, ask questions, and work with whomever you feel that you want to work with. I think that was a question there too.
There's a
So,
question online on the chat as well. Different lenders have different terms and conditions with making double monthly payment towards your mortgage versus annual lump sum payment. What's the difference and what is more beneficial?
Yeah, so every lender has different rules for that. So Meridian itself does have a lot more flexibility with it. We do offer you to be able to make up to 20% of the original balance as a principal payment over the year, and it goes by calendar year. A lot of the banks and other lenders have gone down to 10% or 15%. So again, something to take into consideration when determining what type of lender you want to work with and what your end goal is. But in terms of the question, what's more beneficial of increasing your payment or doing lump sums? It really depends on how much additional cash you have. If you're doing, you're increasing your payment, and let's say your payment is bi-weekly, then you're paying down that mortgage quite a bit quicker because every 2 weeks you're paying towards the principal. If instead, though, you have a large lump sum that you're looking to make on that mortgage, then it would be beneficial just to put the lump sum down. But again, it depends on your financial situation, and also you can talk to your a financial planner to see the beneficial between paying down your mortgage or investing it. There's so many different things just depending on your financial situation.
I will say here, that's part of the conversation as well, right? So now you have a mortgage, you have a closing June the 15th. Now we're going to talk about how do you want to pay this? Do I pay this monthly? Do I accelerate weekly or bi-weekly? Do I do semi-monthly, right? So some people would like to do monthly because of the however they get paid. My suggestion all the time to members, do accelerate it. Because remember, the balance is calculated daily and is charged whenever you decide to make the payment, bi-weekly or monthly. So the sooner you lower this balance in this mortgage, the less interest you pay in the long term. Now, Meridian has a 20%, meaning you can prepay 20% on the original mortgage on a calendar year. So mortgage $100,000, you can pay $20,000 December 31st, come back the next day and pay another $20,000 on the first. That's it, that's prepayment, right? You can also increase the payment as many times as you want by 20%. So if your mortgage is monthly, you can increase the payments as many times as you want during the year by 20%. Provided that you don't exceed this 20% prepayment privilege. Which one is more beneficial? It's a very slight difference here. My rule here is just accelerate and increase the payments whenever you can by 20%, by 20%. Sure, you want to make $100,000, 500, drop it in there. It all depends on the rates as well, right? So what do I do with this money? Do I invest it in my mutual funds at 6%, or I have a term that I'm paying 1.69%? What money is going to give me the greatest kick? Well, if you have a 1.69% on a mortgage 3 years ago, invest it. Dividends is cheap. If we see that the rates are going up, such as COVID time now, and the rate is low, and we feel the rates are going to go higher, kill it right now, the mortgage, because when you renew this, the rate is going to be higher, right? So again, it all depends. I think that we had more time than we're allowed to.
Yeah.
But I think someone had a question right there.
I did. It was with respect to the power of sale homes. Are they negotiable? Or is it, this is the price they put on, if that's the price you pay?
I think everything is negotiable in real estate and in all transparency. Yeah,
Yeah, my exposure to power sale has not been a lot. I totally agree, right? If you come back with a bunch of money right now and I need to pay my loan,
Yeah,
can
if you're
sit
like,
down and
hey,
have
I
a cup
can
of
take
coffee.
it tomorrow for this amount.
Yeah,
It's an offer for them, you know,
Yeah.
everything is, yeah, real estate is really a lot of negotiation.
that's a very good point, right? Everything is
question.
negotiable and don't be shy to ask.
Yeah,
So say we're in a situation where we're past that 1 year period, 20% down opportunity, and like say you come into a lot of money, like you win the lottery, or you like get an inheritance, or your dog digs a really deep hole and you find a lot of duffel bags. So like
get me that dog. please.
what would you do in that case if you wanted to like pay off a bunch of principal?
So you do get the 20% per year.
Or per-
Yeah, so every year it renews.
Calendar year.
So you can take advantage of it. Every January it'll renew and then you can do another 20%. If you win the lottery, I mean, maybe you just want to pay it off. There will be a penalty associated with it, but you can just pay it off. We can calculate what that penalty will be. Or you can just structure it to pay it off 20% per year, just depending. I mean, who knows what's going on in the environment then. Maybe it's better to invest. Again, talking to a financial planner and a mortgage agent to figure out what's best would be suggested.
So if you are a very low rate, such as the ones that we are maturing since 2021, and you are on a rate of, let's say, 1.69, we still have them in the books, and you want to prepay, and you have this, I don't know what happened with the dog, I don't know how he did it, or she, but it's a matter of running the numbers again, right? So the interest is low. The way we calculate penalties ourselves is the greater of 3 months interest or rate differential. It all, whatever is great, right? So if the calculation says that the penalty is going to be 3 months interest and you are on 1.69%, so chances are that that's the way to go. But if on the other hand, you have 2 years on the term and we calculate in 1.69 or whatever into a 2 year term, whatever is there, and the penalty is greater, then maybe that's not a good idea. I know I'm getting a lot of terminology here, but bottom line, it's just a running the numbers. The good thing is that you got money to pay it. That's a good thing.
Yeah.
Okay, with that, I think we'll be wrapping up. Thank you so much, Ashley and Vidal, for a fantastic presentation. This is a truly important topic for a lot of young professionals, especially. It can be very confusing and hard to know where to start. So we really appreciate your time. There's been some great back and forth, lots of great questions. I hope everybody took something away from this presentation. Thank you so much, Ashley and Vidal. You did a fantastic job, honestly.
Thank you.
Thank
Having
you
us.
all.
We also have a small token of appreciation for you. Elton hopefully has. Yep, there he
No, I
goes.
don't need
Thank
it.
you so much for your time.
Thank you so much.
Thank you so much. Don't show the logo, it's our old logo. You can find out the also.
Thank you.
Oh, nice.
Sizes might have been exchanged because I randomly gave you one bag, so just see who's.
Did you call my
Oh,
wife to
yeah,
see what
this
was the
is right, I
size or
think.
what? That did you
I
actually
thought
do?
you told me, didn't you?
Oh, you're right.
Yeah, I did ask him.
Thank you so
For-
much. That's very sweet.
Wow, thank you so much.
For those curious online, it's a special not a YPN, sorry, a Society of United Professionals hoodie. I'm wearing one right now. It's very cozy.
Oh,
We hope you enjoy it. Um, Thank you.
Thank you so much.
No, thank you. I'd also like to extend a few more thank yous. Thank you to Rebecca Caron, Ralph Chatour, and Lori Reed for providing YPN the space to host this session. and for all your support to make this event happen. Thank you to Society Central. Thank you to Sam Ponting and Daniel Lamb as well, and the rest of Society Central for helping to set up the technology and logistics for this event. Finally, thank you so much for all YPN steering members who are volunteering their time to help out this evening and to ensure that this event runs smoothly.